Recently, my dear friends, keep it in mind, in the year of 2015, the government of India has come up with a new methodology to computing GDP. So until this point of time, the way GDP in India is calculated is simply Y equals to C plus I plus G plus X minus M. I mean, the amount of money the household spend, the amount of money investors spend, the amount of money government spends, the exports I make and the imports. So simply by summing up the total expenditure of an economy, I am computing GDP. Okay, so the procedure in India when it comes to GDP is, we in India used to calculate GDP at factor cost. So now you are clear with the difference between factor cost and market price. This is how we used to calculate GDP, okay, until 2015. But in the year of 2008, somewhere in the year of 2008, the United Nations has come up with one innovative measure of national income. That is what we call as United Nations System of National Accounts. United Nations System of National Accounts. So this United Nations has come up with a better variety, a better measure or an improved measure of calculating GDP. And that is using a method called GVA method. GVA stands for gross value added. GVA method of computing. So how to compute GDP using GVA? So before going into how to compute and the formulas that are required to compute, let me explain you what exactly is gross value added. Gross value added, okay, so I think you might be able to decode what exactly is value addition. Value addition, let's say I have raw material in my hand. Let's say I have barley in my hand. Okay, so barley is raw material and I do something, I invest something, I process this barley and convert into beer. Okay, the money I spent, the resources I spent, the labor I spent in producing or in converting barley, a raw material, into a finished product called beer is said to be called as value addition. Okay, I have added value to a raw material. I have added value to a raw material. So here in this case, if you look at this marker, the raw material is simply the ink, okay, the nib and the plastic tube. These are the raw materials. I cannot use these raw materials directly. So what I do, I employ some person to assemble these raw materials and to come up with a finished product. So the contribution by that particular labor to convert raw material into output is said to be called as value addition. So gross value added is simply the difference between the worth of output, the value of output minus the value of intermediaries. Whatever I use it as raw materials. So just imagine, my dear friends, okay, I'll just give an example. Let's say, my dear friends, I'll take the value of output, value added, and the cost of raw materials. Cost of raw materials. I'm just letting you understand what exactly is the basic difference between value added and the value of output. Now just for simple understanding, let's just imagine a particular farmer without spending anything was able to cultivate barley in a unit acre of land, and he has produced, let's say, 100 rupees worth of barley, and it costed him 0. Almost he has spent nothing. Okay, he spent nothing. He spent nothing, and the cost of raw materials initially, just imagine 0. But he cultivated barley worth rupees 100. You get it, my friends? So obviously the value of barley is 100. From 0 he created an output worth 100. So what is the value added? 100. And imagine this particular barley. Okay, this is the first stage of transaction. In the second stage of transaction, this barley has been purchased by Vijay Mallya. This barley has been purchased by Vijay Mallya, because Vijay Mallya owns Kingfisher. Don't pretend as if you never heard about it. Okay, you get it, my friends? Okay, now imagine this barley would be used as an input for beer. So he purchased this raw material. So what is the cost of raw material for Vijay Mallya? Is rupees 100. and he spent certain amount of money to process this barley into beer. Let's say it costed him 50 rupees to convert barley into beer. So now what is the value of output? The raw material plus value added, it is 150 rupees. And how much is the value added? Rupees 50. Now the final output is a beer worth 150. Now imagine it is this particular beer has been purchased by Bottles and Chimneys. Again, don't pretend as you never heard about Bottles and Chimneys, a very famous pub in Hyderabad, isn't it? So imagine this fellow has purchased this 150 rupees. In the third stage, he purchased this beer, or simply the one who is in the lounge in airport, Hyderabad airport. So imagine he purchased it. He doesn't sell it for 150. He again adds value because he has a very good lighting, ambience, music, and that's how he sells this 150 rupees beer, to be frank with you, somewhere at 800 rupees. That's the basic reason, never have beer in airport. Okay, so now what is the final worth of output? 800. How much is the value added? 650. You get it, my friends? So here in this case, if you want to calculate the total worth of output in this country, you can take this into, what is the total output? 800. Or you can also calculate the total output by summing up the value added in every stage, each and every stage of production. So what is the total value added? 650 plus 100 plus 50 is again 800. So you can take the final value of output, that is what is the GDP, or simply you can also calculate the GDP using summing up the gross value added at each and every stage of production. You get it, my friends? And this is the basic difference between gross value addition or simply calculating the value of output. Following? Now let's try to understand how is GDP computed using GVA method. Before going into it, let me also discuss something about the difference between product taxes. Before going to it, let's also discuss about the difference between product taxes and production taxes. Product subsidies and production subsidies. So before trying to understand how GDP is computed using GVA, let's also try to understand the difference between product tax and production tax, product subsidy and a production subsidy. See, if you look at the difference between product tax and production tax, production tax is simply a tax levied during the process of producing a product. Okay, during the process of producing a product. Let's say I am a farmer, I am cultivating barley. What is the tax I am liable to pay during the production process of producing barley is production tax. Can you give me an example of a production tax for a farmer? The land tax. You need to pay land tax. The farmer has to pay land tax. Or if I purchase a land, I have to pay registration tax or stamp duty. I have to pay registration duty or stamp duty. These are said to be called as production taxes. Taxes one is ought to pay during the process of production. So here in this case, how much barley I produce has nothing to do with the production tax. Whether I produce 1 quintal of barley or 1 kilo of barley, but the tax I have to pay is same. That is what is production tax, isn't it? So production tax has nothing to do with the amount of or the value of output you generate. Per unit acre of land, there is a certain amount of tax I have to pay. From that unit amount of land, whether I produce 1 kilo of barley, 100 kilos of barley, 1000 kilos of barley, that doesn't matter, but I have to pay the same land tax. That is what is called production tax. Tax which is incurred or levied during production process and which is independent of the amount of output or the worth of output you generate. But when it comes to product tax, it is a tax levied on the product. It is tax levied on the product. So the amount of tax one has to pay or the producer has to pay would be in proportion to the amount of goods he produces. If I produce, let's say there is a tax, like previously I have discussed the example, HPCL, the government incurs a tax of indirect tax, excise duty of 40%. This is a fine example of a product tax. Excise duty is a fine example of a product tax. How much I have to pay? 40% on every 1 liter of petrol. 40% on every 1 liter of petrol. So when it comes to product tax, it is on the final output. It is on the good or service that I am selling in the market. And the amount of tax is completely dependent upon the value or simply the worth of goods and services I produce. If I produce 10 liters of petrol, okay, 10 times 40% of 1 liter of petrol is something I have to pay. On 10 liters I have to pay indirect tax. 100 liters, on 100 liters I have to pay. But when it comes to production taxes, it is per unit acre of land, that's it. How much output I generate out of it, nothing to do with it. Even when I don't cultivate the land, I have to pay production tax. Land revenue, something one has to pay whether you cultivate or you don't cultivate it. I have to pay certain amount of money, which is independent of output generated. But when it comes to product taxes, tax on the product. If I am producing, let's say service tax, how much service tax the institute has to pay to the government is in proportion to the number of students enrolled. If only one student enrolls in the batch, okay, 18% of one student pays. 100 students enrolls in the batch, 18% of what all 100 students pay. If 1000 students enroll in the batch, 18% of what all 1000 students pay. But there is one tax that the institute has to pay, that is the building tax. Okay, the tax to the municipality, the building tax, that has to be paid whether I am running a batch or not running a batch. Since I have a building, I have to pay it. So that is a production tax. Service tax I pay is a product tax. You get it, my friends? Similarly, production subsidy is the subsidy that one gets during the production process. Like see, the subsidy on electricity for farmers. The subsidy on electricity for farmers. So the input sub, generally what we call as input subsidy, or subsidy on diesel for farmers, subsidy on seeds for farmers, subsidy on fertilizers for farmers. These input subsidies are production subsidies. And product subsidy is simply that particular example. On every 1 liter of petrol, if government says I will pay 60%, you collect the rest of money from the consumer, that is what is said to be called as a product subsidy. You get it, my friends? So these production taxes and production subsidies are independent of total worth of goods and services produced, but these are in proportion to goods and services produced. Clear, my friends? Now looking into it, let's go ahead and try to understand how is GDP calculated. If you look at, my friends, until this point of time, I said the national income is simply nothing but the income earned in the form of rent by the landowner, the income earned as wage by the labor in the country, the income earned as interest by the capitalist, the income earned as profit by the entrepreneur. This is what we have treated as the national income. This is simply what we have treated as national income, and that's the basic reason I said GDP until this point of time used to be calculated factor cost. The cost I incur on factors of production. But never ever we have taken the income of government, mostly in the form of taxes, as an income of the nation. And that's the major difference. Until this point of time, we adopted this new method. We never have taken the income earned by government in the form of taxes as an income of the state. Okay, here in this case, we are only taking factor cost into consideration. Here in this case, the improvement is GDP using this method is calculated using GVA at basic prices. I will explain what exactly is basic prices. So what generally the government does in computing GDP is from each and every sector, okay, the agricultural, forestry, fishing sector, one sector of an economy, and the industrial sector, okay, and then the service sector. So within each and every sector, we compute GVA at basic prices. I mean how much each sector is computing. The gross value added at basic prices in each sector is taken into consideration. You get it, my friends? So the sum of gross value added at basic prices in all sectors, within agriculture sector, within industry sector, within service sector. To this, we add product taxes. Taxes, I mean, this is a money the government gets minus product subsidies. So simply speaking, GVA at basic prices plus product taxes minus product subsidies is what we call it as GDP. Now you might be having in mind what exactly is GVA at basic prices. I'll give you the formula to calculate GVA at basic prices. GVA at basic price simply does mean, okay, the price received by the producer from the purchaser per 1 unit of output, okay, per 1 unit of output, excluding taxes and including subsidies. Simply let's say, okay, the definition seems to be complex because I have not written it on a board. Just imagine GVA at basic price simply does mean, let's say imagine I am the one who is producing it, who is producing a unit of output. GVA at basic price simply refers to the amount of money that I need to spend from my pocket to produce a particular book. Okay, so this is calculated using a formula. I'll just simplify it. Don't just worry about these, okay, these particular definitions, because in fact they are simple. I hope you understand until this point of, okay, this point, and this is something I am trying to simplify. Don't worry. GVA at basic prices is calculated using a formula called GVA at factor cost plus production taxes minus production subsidies. Once I come up with a numerical example, then it would be very easy for you. Don't worry about it. Now again you have a confusion. What is GVA at factor cost? How is it calculated? The formula to compute GVA at factor cost is simply given by CE stands for compensation of employees. Compensation of employees. I mean, to simply speaking, the wages you pay to employees. Compensation of employees. I mean the amount of money you pay to your employees plus operating surplus or mixed income. OS stands for operating surplus and MI stands for mixed income plus CFC, which stands for consumption, of fixed capital. Consumption of fixed capital. Following? So you just make a note out of it. Then I would explain how is this method computes GDP, and I will try to simplify it further by taking certain numbers into examples, so into consideration, so that it will be easy to understand. I hope you, okay, it has become very easy when I have explained how national income or NNP at factor cost is calculated using an example like HPCL and amount of money paid. Similarly, we can also take some numbers and try to understand how GDP is calculated using GVA method. Keep it in mind, friends, GDP is calculated as of now, after the change in computing GDP in India in 2015, the GDP in India is calculated at constant market prices. As of now, GDP in India is calculated at constant market prices. What is constant market prices? I will explain, don't worry. Okay, so since beginning of 2015, when India has adopted this method, we compute GDP, okay, at constant market prices. Previously we used to compute GDP at factor cost. Now the change from 2015 is we compute GDP at constant market prices. How do we calculate it? By summing up gross value added at the basic prices from all sectors. To that we add the product taxes and subtract product subsidies. And how is GVA at basic prices calculated? Is simply taking GVA at factor cost, adding production taxes and subtracting production subsidies. And what exactly is GVA, gross value added at factor cost, is simply given by CE, stands for compensation of employees. You can remember simply as wages Okay, here in this case I referred as wage. Here in this case I am using certain technical term, but keep it in mind, it is nothing but the amount of money I pay to my labor. That is what is generally technically called as compensation of employees. Okay, I am compensating for the service rendered, that's it. That is generally what we call in simple terms as wage. Operating surplus or mixed income is simply any other form of income. Okay, operating surplus or mixed income, the profit I make by any other means, it could be rent or could be interest, any other. Okay, so here in this case rent, interest, instead of including rent and interest I am saying the other. Operating surplus, mixed income, so the other forms of income. Okay, and consumption of fixed capital, it does mean the depreciation, the component of depreciation. Okay, so now let's look at from this particular level and trying to understand how GDP is calculated. GVA at factor cost. Now let's say friends, the same HPCL. Okay, let's take the same example. The same HPCL is producing 1 liter of petrol. So in the process of producing 1 liter of petrol, it has to pay certain amount of wages. That is consumption of the compensation of employees. And there has to be certain other form of money that company has to spend, and that would be part of operating surplus or mixed income, which also is a part of its profit. At the same time, the company, since it has certain machinery, there will be wear and tear loss of that particular machinery, so it keeps certain amount of money aside in order to retain that particular ability of the machine to work. So that particular part, amount of money it keeps aside, is what is said to be called as depreciation component. Now imagine, okay, here in this case I have clearly mentioned 100 rupees for rent, wage, interest and profit. Now the same 100 rupees I am distributing. Just imagine for HPCL, it costed 100 rupees to produce petrol. Out of 100, let's say 30 goes here, 30 goes here and 40 goes here. This is how it has spent money to produce 1 liter of petrol. One is salaries, one is profit, and the other is to overcome the wear and tear losses. Okay, now it has spent 100 rupees. But in the process of producing petrol, okay, the HPCL might have purchased a machinery. During the process of producing petrol, the HPCL might have imported a machinery to refine oil. On the imported, okay, commodity or the machinery, I might have paid certain taxes. So that is also from my pocket. From my pocket, isn't it? I am the one who imported, so that is also from my pocket. But at the same time, you may imagine the government also has helped me, because I am setting a refinery unit. Imagine the government also has given a subsidy. So to me, frankly, in producing 1 liter of petrol is not simply the amount of money I paid to my people. I should also consider the tax I paid on the machinery I imported, and I should remove that support from the government, okay, which helped me during the production process. So at the end of the day, even though I have spent 100 rupees here, but in the process of producing petrol, I also paid 10 rupees of tax. But the government, since, okay, I am in the business of producing petrol, it might have helped me up to 20 rupees. So to be frank, what really costed me is 100 rupees I have spent for these people, 10 rupees is the tax paid, and 20 rupees is subsidy, isn't it? So what really costed for, okay, to produce 1 liter is 110 minus 20 is 90. So this is how we take the GVA at basic prices from each and every sector, and we sum up all this gross value added. So here in this case, gross value added by HPCL, gross value added by BPCL, gross value added by all farmers, gross value added by each and every sector. To that, we add the taxes, which is the income of the government. You get it, friends? And we subtract the subsidies, product subsidies. So what I am doing at the end of the day is simply, when it comes to GVA at basic prices, it is simply this particular component, I mean the income earned by factors of production plus the income earned by government, okay, is taken into consideration. Okay, so that is the basic difference. Here in this case, I am not including or I am not considering at all the income made or income generated by the government. And the major change here in this case, it is not only the income earned by factors of production, I am also taking the taxes, which seems to be the income of government, also into consideration, and that's how we compute GDP using GVA. And in fact, my friends, since beginning of 2008, once United Nations has come up with this measure, almost all the nations have adopted this method of computing GDP. Even IMF started projecting or estimating the GDPs and growth rates of an economy using this method. Since now we are in a global world, that's the basic reason. As a practice of trying to adopt the international practices, the government of India also has moved from this method of C plus I plus G plus X minus M simply to this method of computing GDP. You get it, my friends? So at the end of the day, the very basic difference between these two methods is, in this method, GDP is calculated at factor cost. In this method, GDP is calculated at constant market prices. What is constant market price? I will explain you, but you can easily make it out. When I say market price, does mean I am taking tax into component. In this case, when I mean to say income, I simply mean to say income earned by the landowner, labor, capitalist, and entrepreneur. But in this case, when I mean to say income earned by the employees, landowners, labor, other people, other components, also government. You get my friend? That's a major difference. The reason why, in fact, this method of computing GDP, how am I computing GDP? Looking into the consumption expenditure, investment expenditure, government expenditure, and exports. So this is something I am looking from the demand side or the consumption side of an economy. So if there is more demand and more consumption, more would be the value of C, more would be the value of I, more would be the value of Z. So this method of computing GDP is through demand side or consumption side. But here in this case, I am not looking into the consumption, I am looking into the production. So this method of computing GDP is from the production side or supply side. So if more companies and more factories are producing more output, my GVA increases. Irrespective of the demand, my GVA increases. So if more companies, more farmers, more people do contribute more to the economy, they produce more goods and services, simply my GDP increases. But here in this case, it's not simply about production. What matters is simply the consumption. If there is more consumption of goods, more demand for goods and services, GDP increases. Here in this case, I am emphasizing on production or supply side. Here in this case, I am emphasizing on demand or consumption side. You getting my friends? Following? That's the basic difference. The reason why and how is it is an advantage than compared to this particular way of measuring GDP is simple, my friends. Now let's say last class I might have discussed the contribution of agriculture sector to Indian GDP is 14%. And at the same time the manufacturing sector is hardly 16%. So instead of looking into the overall consumption economy, if I try to measure the overall production of each and every sector and economy, then the government could able to manage or can concentrate which sector is contributing how much percentage, which sector is experiencing problems in contributing to the GDP, which sector really helps certain amount of support by the government to increase its contribution to GDP. You get it, my friend? That is what the government can take a stand when the government starts measuring the GDP using production side or supply side. You get it, my friend? So here in this case, you can better understand which particular sector really requires support, which particular sector really is struggling to contribute to the growth of this economy. You get it, my friend? And henceforth, the government of India has thought this would be the better way of computing GDP, and that's the basic reason in the year of 2015 we have moved from this particular measure to this particular method of computing GDP. Got it? This is said to be called as gross value added method of computing GDP. Following. Now let's look at the next aspect. We have seen different measures of income, and we have seen different ways of computing and the recent change in computing GDP. Now let's go ahead and try to compute how is the growth of an economy computed. So until this point of time, we are only looking at how to calculate income. Now let's look at how do we compute the growth of this income in a country. So whether we are making more money or we are making less money. When do we make more money? When we produce more goods. When we make less money? When we produce less goods and services. So an economy is said to experience growth when it is producing more goods and services, isn't it? It's obvious when I mean to say growth, I mean to say the prosperity of the society. When do people prosper? When they have more money. When do they make more money? When they are employed. When do you think they would be employed? When the society as a whole is producing more goods and services, isn't it?